All right, 2602, welcome. Great to see everybody on here today. We're going to talk about funding today. Everybody always asks tons and tons of questions about how do I finance my franchise business, and this tends to be one of our most popular topics from the ground up. Most people are familiar with getting a loan for a car or a house or things like that, but this one is one that people are very you just don't do it very often. So we're going to cover all of that, take the mystery out of financing your business, and we've got some great information, some great topics here today. Okay, let's get on to the next section, next slide there, if you would, please. Guys, this is where we've been. So we started this journey a little over a month ago with that information session. We did our kickoff, and then we took about 3 weeks off between February 20th and March 12th from the group activities to give you an opportunity to really be one with your coaches, to do the introspection. You've done your Zoracle profiles, you had your discovery calls with your coaches, and started to take that initial list of maybe 12 or 15 franchise concepts and whittle that down to perhaps 2 or 3, and make the introductions and sort of start going external into the due diligence phase, where we've introduced you probably to 1 or 2 different franchise systems. And so we're really, at this point, kind of right in the middle of the whole process, right? We're right in the middle of the 10 steps, and we're also right in the middle of that center part, that second phase, which is really due diligence. So at this point, we're really down and dirty on a couple of different franchise systems, looking at all of that. And obviously this, the financing piece of that is a really, really key component. It's important to know how you're going to be financing your business, because that's really going to be something you want to get a lead on, right? If it's going to be a ROBS or it's going to be an SBA loan, you want to be able to prepare to have the necessary cash injection that might be required for that. You want to be able to do that as far in advance as possible. And some of this stuff, like a ROBS, involve just a lot of administrative paperwork. SBA loans require pre-approvals up front and then final approval. So all of this stuff just takes a little bit of time. And so it's important to do it now, so that when we get to the point where you're ready to, you figured out the right franchise for you, you've got the ability to kind of pull the trigger, and you don't lose that opportunity because, we didn't do the necessary things up front to get the financing squared away. So that's what we're doing today. We will be meeting again a week from today, and we'll be talking about further steps in due diligence, which really great stuff. The FDD, the franchise disclosure document, phenomenal document. Sometimes can be a cure for insomnia. It's very big, but there's a lot of great information in there. Some of you may have already received that. If you haven't yet, you will very soon. But I recommend that you read that and really understand. It really describes what that relationship between you and the franchisor is going to be like. It really describes every facet of it. And so we'll be talking about that, as well as validation next week. Validation, I think if you ask any of the coaches here, they will all tell you that that's the best part of the due diligence. That's when you get to have an opportunity to talk with other franchise owners that are in the system. And the $1 million question, would you do it again? What do you like about it? What don't you like about it? What level of support do you get? How much do they help you with this? How much do they help you with that? Where are you more on your own? What's the culture like? These are all just critically important questions. And I would also say, not to jump ahead a little bit, but I will, an answer for one person is not necessarily going to be an answer for you, right? You have to really understand one person's like may be your dislike. One person's dislike may be your like. So you really need to understand, when you do validation, who you're talking with, and maybe the perspective that they're coming to it from, and be able to answer the question. But They can also share with you financial information about their performance at their franchisee that coaches and franchisors are just legally not allowed to do. So really great information there. So we'll talk about that in a week. And then 2 weeks after that, we will have our group presentation, group meeting on Discovery Day, also known as Meet the Team Day, also known as Confirmation Day. And that's when we get to the decision part of the sort of the decision phase, which is up in steps 9 and 10. And that's where we have an opportunity to find out if the franchise system thinks that we're a good fit. If they do, they will invite us to that Discovery Day. And then we'll typically have about 1 to 2 weeks to make a decision. If they offer after Confirmation Day, if they offer a territory, typically 1 to 2 weeks in order to make the decision as to whether or not we're going to accept it. And then about a month after that, we give everybody a little bit of lag time to get into graduation. We will honor every graduate, regardless of whether you move forward with step 10 and become a franchise owner or not, provided that you've met all the graduation requirements. We'll honor all those graduates, and we will make special recognition for those who have already become franchise owners by that point. So this 3-month journey, just about at the halfway point. Hopefully you guys are enjoying yourselves. If it feels like a fire hose of information, it should. There's a lot of information being passed, but you are being guided by franchise's finest. The coaches that you've got are phenomenal, and hopefully you're really engaging them and getting great feedback. I know you are. Okay, next slide. So this is where the class stands. We can see we're kind of all right where we should be. I would say if you're not yet in step 6 or at least step 5, you're probably a little bit behind. Not too late to catch up, but I would say make sure that you schedule those presentation of options calls with your coaches, and so that you can kind of get to that second phase, which is due diligence. Because last week, this week, and next week, these group calls are all around that due diligence. So you don't want to fall too far behind. But for those who are in steps 5, 6, 7 right now, great. You guys are moving right along, right where you should be, and all good. Okay, next slide. Okay, Edgar, Sherry, who do we have speaking today on the financing?
I'm here, Jonathan.
Jonathan Pace.
Jonathan's speaking. Okay, great. Thank you, Jonathan. So we will we'll just talk briefly here, and I'll turn it over to him, but lots of different ways to really talk about, to really fund your business. The nice part about it is that it really can fit like a custom suit, right? There's a lot of tax consequences that are involved in the way that you're going to choose to fund your business, how much cash you have or how much cash you don't have. Some of these will require you to have a certain type of legal entity, like a Rob's will. You're required to have a C corporation as opposed to an LLC or an S. If you have money in your home or your retirement, you have options. So there's just a lot of different ways. And a lot of people say, this is what is the best way to do it? And the answer is really the best way to do it is the one that fits you best. The good news is there's a really big menu of options to be able to custom fit that to you. So without any further ado, Jonathan, if you would take it away.
Thank you. Happy to be here today. My name is Jonathan Pace. I'm one of the strategic advisors here at Reader CPA Group. We are a virtual national CPA firm with physical offices in Chicago and the Portland, Maine area. Over the last 11 plus years, we've really built a niche in working with franchise owners, helping to be a free CPA resource for candidates during the buy-in process, making sure that we help answer any of your questions, make better decisions, set you up for a strong foundation before you launch your business. And some of the main things that we talk about in these strategy sessions are entity structure, funding strategy, just overall high level guidance on FDD item 19, item 21, unit economics, financial red flags, making sure that we have all the information. And so over the last 11 years, we've done hundreds of consultations with franchise candidates, and there's always a lot of questions around entity setup, funding strategy from the lens of strategic tax planning. And so, as we look at it, Michael calls it the 3 buckets framework. And for everybody, as Chris was saying, it depends on your situation. And so bucket number 1 we look at is investment level. What's the initial investment, franchise fee, build out, equipment, plus 12 months of working capital. Most of the FDDs may only include 3 months, but to your best of your abilities, we estimate, what would 12 months look like to understand the all-in number. Bucket number 2 is really all about your personal financial statement. We're looking at cash, liquidity, non-retirement accounts, retirement accounts, real estate. And the purpose is to really understand your financial situation and understand, where there's opportunities. And bucket number 3 is all about your household income. That includes W-2, spouse income, VA disability benefits, military pension, rental income, any other, income sources that you might have. And that helps to really see where your cushion is and your SBA eligibility strengths, ability to support loan payments. And all 3 of these are really connected. And in order to make our recommendation, without that, it's very hard to have a strong, entity structure and funding strategy. For everybody, it's different. Some people may be a LLC with an SBA loan. Other people, it might be a security back line of credit. Some people, it's the Rob C Corp. And really, we have to understand those 3 buckets in order to make that recommendation. And so there is no one size fits all. It all depends on your financial picture, your risk tolerance, your goals. And, we get into that with everybody as we, get into our consultations. Next slide, please. And so the different entity structure types, let's unpack them. Most of the time, it comes down to LLC versus C Corp. And the C Corp mainly comes into play when we're talking about using the ROBs for the funding strategy. And so just to unpack, an LLC, that is a legal structure. By default, a single member LLC is taxed as a sole proprietorship, and it files on your Schedule C. 2 or more owners is taxed as a partnership by default. At any point, either at inception or later, you can elect to be taxed as either an S corporation. This is mainly to save money on self-employment taxes, or a C corporation. It's pretty rare that we would see the election to be taxed as a C corporation. When we're talking about ROBs, you're going to start off as a C corporation, but an LLC is essentially a hybrid entity that can elect different tax statuses as the business grows. Typically, once you get to about 50,000 in profitability is when we start to think about making that S Corp election. And that again is to save money on Social Security and Medicare taxes. And so the C corporation, this is required to do the ROB structure. And essentially, this is because you're going to set up a C corporation, which will then set up its own retirement plan and then essentially invest in stock in the company in order to fund your business. And so when we're looking at it, you don't necessarily, your retirement plan is essentially the owner of the shares in the company. And so it does require you to be a C corporation. Some of the biggest benefits are there's no debt, and you're able to access your retirement without any early withdrawal penalties or taxes on it. There are some compliance requirements and ongoing administration when we talk about the ROBs. You always want to work with one of the major providers out there like Benetrends or FranFund or Guidant or Tenant, and they'll help you set it up and structure it the right way. So with any of these entities, the formation steps always starts with filing your articles of incorporation, applying for your EIN with the IRS, registering with any applicable state authorities, payroll taxes, sales taxes, making sure that you have any required business licenses, permits, setting up your payroll and accounting systems, just making sure that you've got everything the way it needs to be. And some common questions, if you're going the ROBS route, the 401k, it does need to be eligible for rollover. So you can't typically use your current employer's 401k. Has to be like a prior employer's 401k or IRA. And, that's how you end up, using that for the rollover to fund your business. Let's go on to the next slide, crafting a winning tax strategy. And so key deductions for franchisees. Now, terminology matters. And when it comes to things like franchise fees, royalties, just to unpack, the franchise fee, that is the upfront fee paid to the franchisor. It can vary, sometimes, 30 to 50,000, depending on the franchise and how many territories or units you're buying. This is the fee you pay to get in, the right to operate the brand. And essentially, one thing to note is it's not an immediate expense. This is what's known as a Section 197 intangible asset. It will be amortized over 15 years. And so you don't deduct it all at once. You will deduct that over time. But other startup costs, marketing expenses, labor expenses, there are some things that you will deduct all at once. Some things that you may already be paying for, may turn into business expenses, things like home office, vehicles, gas, travel. Some of those things might go under your business now. The immediate expenses like training costs, the grand opening, any professional fees, those are going to be deducted at the time they're expensed. Let's see, tax strategies for veterans. Veteran-owned businesses may qualify for certain advantages. There's always proactive tax planning for year-round benefits. We always try to say that it's very hard to have a tax strategy if you're not proactively meeting sometime mid-year, sometime near the end of the year, to really see what kind of decisions we can make to improve your overall tax situation. Let's see, effective tax management. This is really important, maintaining accurate financial records. And from the beginning, you want to be keeping a clean set of books. Some of the franchises out there do have required bookkeeping vendors and systems, but others, allow you to choose your own. We always recommend QuickBooks Online as a starting point. It's our go-to for all of our clients. And the more you set it up from the beginning, the better off you are. And of course, collaborating with your CPA for optimal tax outcomes. Again, it all starts with keeping an accurate set of financials. This is going to streamline your tax preparation, tax strategy, overall cash flow management, profitability analysis, allowing you to really make decisions for your business. And so it's always a green flag when you have clean, accurate, up-to-date financials, organized reporting. This allows you to really understand how your business is performing. Obviously, if you're behind on your books, don't have accurate numbers, this is going to cause some issues and not allow you to make good decisions that you should be, keeping an eye on. And so, best practice is always don't wait until tax season or the end of the year to start cleaning it up. Get in the habit of keeping an updated set of books. If that's not your strength, then outsource it, and a firm like ours or others can handle that for you. Avoiding common pitfalls, staying compliant with payroll and employment taxes. We always recommend using a third-party payroll provider like Gusto or ADP. QuickBooks does have a payroll system, though there is some manual entry and it's not quite as streamlined as some of the third-party providers, but that ensures that all your payroll taxes are filed correctly, it's made on time, reduces the risk of penalties and the administrative burden that it comes with. They understand all your state and local tax obligations to help make sure that you've got everything you need. And, depending on what business you're going into, if there's sales tax applicable, they'll make sure that you have all that taken care of. So keeping everything clean makes it a whole lot easier to run your business. Unit economics. Let's go to unit economics.
Hey, Jonathan, there
Yes.
was a question. I think,
Oh.
Cynthia, did you raise your hand? Did you have a quick question?
Yeah, I did. Jonathan, you mentioned about the taxes and the amortization about 15 years, more or less. With the new beautiful bill that come up this year, you can actually do deductions 100% on the first year in some items. That this one apply also in this case, or is different?
That is, you're talking about they brought back bonus depreciation. And because this is an intangible asset, it's not eligible for bonus depreciation. So the 15-year amortization would still apply to it. But there are certain things that are eligible for that 100% bonus depreciation that big beautiful bill did bring back to 100% now.
Okay, so it's applicable in certain stuff that I need to read through to the taxes, correct?
Yeah. Yep.
Okay, thank you.
Depending on maybe some certain equipment,
Correct.
vehicles,
Correct. Okay.
things like that now, are eligible for 100% bonus depreciation.
Thank you.
Great question.
My pleasure. Any other questions? Okay. All right, I'll keep going. So unit economics, again, back to what I was talking about with keeping a clean set of books, the importance of P&L statements to be able to track your revenue, your cost, profitability. In the beginning, if you're starting off as a new franchise, it's totally normal to operate at a startup loss, and pretty much every business starts off there. There's no customer base. There's always the ramp up period. And you want to make sure that you're planning for that ramp up period. certain marketing expenses, what's it going to take to hire enough employees, the overall operations of the business. And this is where building your projections, most of the franchises will provide you with like a blank Excel sheet. It's a great exercise for any small business owner to go through to be able to, start to understand what this is going to take and, start to be able to make some estimates. You can get a lot of information by talking through the validation process to existing franchisees, asking them questions, but making sure that, early on, cash flow is what keeps the business alive and operating. Profit is what's going to come later. And so you want to make sure that you plan for whatever that ramp up period is going to look like. How long from that opening day is it going to take to get to break even? Do you have enough working capital to survive the ramp up period? And, the risk is always, running out of cash before reaching profitability. Some of that is going to depend on you as the owner. Are you going to run your business from day one? That's obviously going to have lower payroll costs. You're going to have more control. The trade-off is always the time commitment. Although as a business owner, it is a good idea to be involved as much as you can. Are you going to hire a GM or a manager? That obviously gives you more flexibility, but it does come with higher payroll cost. And sometimes we have to plan for a longer time to profitability. But overall, making sure that we know what does that break-even timeline look like and what's the required capital to get there. And you can use the FDD to be able to start to have some expectations. It's a really great benchmarking tool. The validation calls that you're going to have, those are another opportunity to see what is realistic. And you can also use industry standards to have some other benchmarking capabilities. So it's not only can I afford to start it, but can I afford to sustain this until we get to profitability? And knowing what that break even to profitability period looks like. I see a hand raised.
Yes, me again.
Yes.
Sorry. It is any rule of thumb that to have 6 months, a year, whatever it is, as a buffer to just break point or something like that?
So we always say, good rule of thumb is to plan for 12 months and, hope that it comes somewhere in the middle. A lot of times the FDD is planning for like 3 months or 6 months, but, planning for that first year, because there are just certain unknowns that you want to make sure that no matter what, you're going to have enough runway to be able to get through that first year. And so I would say a good rule of thumb is, plan on the high side, look at 12 months, what would it take? Hope that it comes in somewhere in the middle, but, at least you have that first year to get through that ramp up period. Yes, another question.
Hi.
Hi.
Hey, Jonathan. Question about Social Security. I'm about to kick off the Ticket to Work program with SSDI, and I talked to their advisor today before this meeting to get a sense of what the implications were for the Ticket to Work program, Social Security, and the ramp-up period. And I was left very much confused and unclear about the implications of this. During the ramp-up period, before you hit your break-even point, are you expected to be paying yourself a salary as part of that ramp-up cost? And would you have a taxable salary that you're funding through your initial capital infusion, or how does that work?
So a great question. And like a lot of answers in accounting and taxes is it depends. And so it really does depend on your situation.
Okay.
And of course it depends on what kind of income, hence the 3 buckets, looking at what that looks like. There are definitely times where people, they need something to live off of, and they will include that. I would say sort of a more general rule is if we can live off of other income sources, that is like option number 1,
Yep.
but to not necessarily have to build that in, because of course then you're paying more interest, or taking more out of your retirement accounts. And so it depends. As a business, you don't as the owner, you don't necessarily have to take a salary.
Okay.
And so if you can push that out till you get to some profitability,
Yep.
that is the goal for most people. And so, or very minimal, if necessary, it's kind of on an as needed basis, I would say.
Great. So it's legitimate not to pay yourself as the owner until you reach break even. That, as long as you've got other income streams.
Oh, totally.
Good.
Yeah.
Awesome.
Yeah,
Yep.
absolutely.
And I would say in a lot of cases, quite common.
Yeah.
Yeah.
Oh, yeah. Yeah.
I thought so, but I wanted to confirm you. Thank you.
Yeah.
Jonathan.
Yeah.
Yeah.
Exactly. No, trying to preserve as much of that, capital for the business, and taking, money out once you get to profitability. And so, very common and usually the goal. Great. And so let's see. I think we covered most of that. Let's go on. Oh, that was the last slide there. Okay.
Jonathan, that was fantastic. Thank you. And great questions, guys. You obviously have put a lot of thought into this so far, and have done a lot of your due diligence, especially around the FDD and thinking through some of your funding and the financial aspects of it. Before we move on, any other questions specifically for Jonathan on entity? Oh, Michael again, please.
Just occurred to me when you talked about outsourcing things that are not your core competency. I'm in the process of working with my son, who's a CPA. He's an accounting manager at a firm that builds data centers. Does AI data centers. His company is one of the companies that builds those. And I'm trying to convince him to come on as my partner and CFO, right? So he'd be the CFO and I'd be the CEO of the franchise. So you talk about, it's not a core competency of my son, who's a CPA, but he does data center stuff. As in the CFO role, he might want to seek advice from another CPA. So is that a structure that makes sense for a franchise where my son's my partner? He's the finance guy. I'm getting an MBA thanks to the U.S. government. I'm at Rice getting my MBA, but my son is a longtime accountant. So would it be in line with this strategy of outsourcing things that are the core competency to have a third party such as your firm as a consultant to my son, who's the CFO?
I'd say, we really try to customize all of our services depending on what your needs are. And so, having somebody like that as a partner, I mean, I love it. I love the family aspect of it.
Yep.
And obviously, there's, a lot of synergy there.
Well,
And, we can come in at whatever capacity you need us at. Some people are happy to, handle some of the bookkeeping.
Yeah.
Again, especially in the beginning when the volume is lower, it can make a lot of sense later on. Of course, if you wanted to outsource more of that, we can come in at whatever capacity you need us to be. And
Nice.
we don't necessarily have to handle the whole thing. We definitely can advise as needed and have strategic planning meetings and, wherever you guys need help. So I think,
Fantastic.
I think-
Please, Sarah. Sorry.
No. I was going to say, I think, to use Jonathan's term, it depends.
Yeah.
You and your son may not know yet. And then when you get into it, you're like, oh, here's the gap, and so we're going to use, someone like the reader group or Jonathan to help with that. Or maybe there's nothing you think you need help with. I mean, I think it would depend.
Yeah, I think it's probably dependent upon the franchise too. They're going to have requirements, and I haven't asked the question. This has been great for me to build up a question bank for the next meeting with the franchise, one that I'm leaning towards of my last two. I want to be able to ask them questions about this financial structure and bookkeeping, and if they have a system they want us to use, or can we go out and get the QuickBooks online and use the integration with ADP. To do payroll. It's still to be determined, right? Depends. And I can ask those questions. So thank you for queuing me up to ask some questions of my franchise.
Fantastic. Thank you.
Thank you.
And, in my franchises, in my experience was I did get a chart of accounts from the franchisor to set it up. So it's not like I had to reinvent the wheel. They gave me the chart of accounts for QuickBooks. It was pretty straightforward.
Nice.
But did I always have a CPA with doing my taxes? And then I was uncomfortable doing some sales tax stuff, and I had some assistance with that. And so I wanted to get in there and figure it out. And then I'm like, oh, I'm uncomfortable doing this. This is fraught with peril. I will outsource that. And so I did.
Yeah.
And so I think as part of your training and figuring out what they're going to provide and some of the frameworks, and then you can figure out what are you comfortable with. And the other thing that you'll get to know is when you do validation, and even at training, you don't have to have it all figured out. Even when you make a decision, you may be like, oh, I kind of think I'm going to outsource X, Y, and Z. And then you go to training and you're like, you know what? Absolutely. You talk to other franchise owners and your neighbor and go, well, what do you do? They'll typically give you a list like for payroll. And I love Gusto. Gusto, I enjoyed them. And I use that for my payroll in my last franchise. Brittany is giving the little clapping emoji there. It's very fun. They have like a little animated piggy bank that runs across every time you do something. But they gave me a list of preferred vendors for different things. And then I would ask other franchise owners, what do you prefer? And they would overwhelmingly be like, oh, we love Gusto. Fantastic. And that's what I would go with. So, you're not going to have to reinvent the wheel. Even when you outsource, you can work with your coach, and we will happily recommend some resource partners that you can use for accounting, finance, funding, and legal work. And then the franchisor is going to provide a list. But I think the key is focus on the tasks that are going to grow your business. And your time is going to be precious. And let's say there's a few of you on the phone that maybe are going to keep your day job and are going to run the business 15 to 20 hours a week. Well, that 20 hours a week is pretty precious. How are you going to spend that time? And using trusted partners to do the other things is key. And quite frankly, it helps you with compliance. It helps you minimize your exposure financially, etc. Okay.
Yeah, and I would agree with that, Sarah. Really great points.
Yep.
I highly recommend outsourcing early. Even if you think I can handle my bookkeeping now, your business will start to grow pretty quickly. And pretty soon your books might just be a mess. And then bringing on a bookkeeper at that point and trying to explain everything, it can get really complicated really fast. So that would be my biggest piece of advice is outsource early.
Yeah. You're right, because it could spiral slightly out of control. Then you're bringing a bunch of paper and receipts, and it's ridiculous.
Yeah.
So we have a quick 3-question quiz here. And so guys, let's fill that out. What are the ways you can use retirement funds? It is all the above. There is a basket of retirement funding, and that includes a rollover for a business startup, a 401k or TSP loan, or a withdrawal. And as Jonathan mentioned, there's kind of pluses or minuses. And I believe, Jonathan, you mentioned what some of the limitations are, like on the withdrawal or the loan, correct?
That's a good point, and maybe I didn't touch on it quite enough, but with the 401k or TSP loan, you can borrow basically 50% or 50,000 of the plan's assets. And so it's another great strategy, especially if you're looking for some liquidity to, put down on your SBA loan, to be able to borrow that money. It doesn't lock you into the ROB structure with the C corporation, so you can set it up as an LLC. We even recommend setting up a new 401k plan for that new LLC with a borrowing provision in it. And say you have like an old 401k or TSP, you can, if it's eligible for rollover, you can roll over, all of it, or 100,000 will get you to the maximum limit of 50,000. And so it's another great way to get some additional liquidity and be able to tap into some of your retirement, another retirement funding strategy that we definitely talk about often.
Indeed. No, thank you for that. And I think that helps. So a rollover for business startup can be good. That's how I funded my first franchise. The only other point I'll make about a ROBS is you don't have to use or roll over the entire thing. Like I had 600,000 and I rolled over 350,000 and kept the rest, in a retirement account. They say that a minimum of 50,000 or above to roll it over. Otherwise, the fee structure just may not be worthwhile. The cost of capital may be a little bit out of whack. So ROBS can be good. I liked it because, I completely self-funded. I was able to put some of my assets to work. And then when I sold that franchise, almost 8 years later, I put it back in a retirement account. And off I went. But you do have to have, the C Corp. So there are other avenues to leverage retirement accounts. And that's kind of what this question is just trying to say. There's more than just a ROBS, to do it. Okay. What entity is required? And I think I just said this, not realizing that would be the next question. This is, remember, the only funding type that will dictate what type of entity that you have. It starts with C, in case you were curious, as a, so if no one is on, it is a C Corp. And so, as Jonathan talked about, there are some, tax implications with that, with the double taxation. But, if you know that going in, there are ways to sort of identify and address that. Okay. And what are the primary ways of funding your business? Bear in mind, there's not a one size fits all. So that may help you. It is a little bit of everything. And so, really, just to reiterate, you're going to think of, even if, unless you're completely self-funding, if you are going to do some form of loan, SBA being the most, popular or most common, you still have to think that 10 to 30% equity injection, where is that going to come from? That's coming from you. Michael, feel free.
Quick question about the C corporation versus LLC. and doing a mix of SBA and ROBS funding. So is there an implication in terms of the kind of corporation you're founding? Can you do both under a single corporate entity?
That's a
What would it be?
great question. And what dictates it is if you do a ROBS, even if it's not for the whole thing and you get a loan, you will still have to have a C Corp. If a ROBS is involved at all,
Okay.
C Corp. So great question. And to be clear, the franchisor, doesn't necessarily care what kind of entity that you have, but they care that you have one,
Right.
because they want you to protect yourself, protect your assets, and quite frankly, protect them.
Right.
That you're protecting your franchise, which protects the franchise system.
Does the C corporation structure have the same protections of assets as the LLC?
Jonathan, feel free. You can.
Yes. Yep.
Good.
And in some ways, I would say equal, maybe even if not more protection in some cases. Yeah.
Could even be considered.
Yes. And guys, to not get into the weeds, but some of you have read an FDD, so bravo, you guys are way ahead of the curve. This is a great academy class. Your entity, when you read the FDD, the franchisor will say you cannot use the name of the franchise and the name of your entity. So if you're getting an LLC, it might be like MD Services, because I'm looking right at you, Michael, like MD Services LLC, and then you get a fictitious or doing business as, Budget Blinds of St. Paul. So your entity is not typically consumer facing.
Right.
You're using it for invoicing and tax purposes and that kind of thing. So some franchisors kind of want to weigh in on the name just to make sure that it doesn't violate their rules.
Right.
But you will run your business typically from a consumer facing under your fictitious name, which will include the franchise. Okay.
Mm-hmm.
What is the main difference between the franchise fee and the royalty? I know a lot of you know the answer to this, so if you're brave, you can feel free just to shout it out. That's it. The franchise fee is the one time. Typically, the way that it works, when you sign the agreement, you pay the franchise fee. And once you pay the franchise fee and sign the agreement, now you're official. Even if you're waiting for your SBA loan to fund for the rest, once you pay the full franchise fee, you are an official franchisee. That's what typically triggers starting training and all the other, you get the secret handshake and that kind of thing. Okay. All right. So we have about 10 minutes left. Any other questions? And while I'm thinking about it, Jonathan, I'll say one of the things for a lot of you that are thinking through your funding and you're thinking about an SBA loan or some kind of business loan, what is probably the most common scenario is that you will pay the franchise fee, obviously after the veteran discount, out of your own funds, and you will get funding for the rest. That is probably the most common scenario. Now, often you may need, if the franchise fee is a little higher, you may need the loan to close to pay the full thing. And in that case, you just work out the timing with the franchisor. Maybe a deposit is paid, and you could sign the agreement, but you're not official until the full franchise fee is paid when your loan closes. So there's a lot of different scenarios, but that's the most common. Charles, feel free.
Question for Jonathan. Appreciate what you said and all the help you're offering. How do we get in touch with you or stay in touch with you when we have specific questions down the road?
Yeah. And your coach you're working with should have our email, and typically they make a warm introduction. We'll get you in with our we also do like some weekly webinars with Michael and I that host them, as well as providing free one-to-one consultations where we can get into your situation specifically. So I would say reach out to your coach, have them make a warm introduction, and we're happy to, help as much as we can.
Fantastic. I would assume, Jonathan, this is a busy time of year.
Oh yeah, this is
Yeah, this is your Super Bowl. Yes.
Yep. At least another month or so, and then it'll ease up a bit. But this is definitely our busiest time. But we're still available, so we'll make sure that we help you, and get you in as soon as possible.
Yeah, I find that pleasantly surprising that you guys are able to meet with people at this heavy tax time of year.
Oh yeah. Yep. Well, we've staffed up for it. Michael's been doing these over 11 years now, and so big reason I came on board and joined up with him.
Well, fantastic. All right, guys. Any other questions? If not, we're going to go into a breakout with your coach. So,
Sorry,
Jonathan, thank you
question.
so much. Yeah, go ahead, Brittany.
Jonathan, for those one-to-one consultations that I'm sure most of our Vetrepreneurs are gonna, want that warm introduction. But do you have any recommendations for maybe things they should bring or be prepared to speak about, like during that one-to-one meeting? Anything you guys are looking for specifically at the CPA firm?
That's a great question. And so we do have like a brief intake form that helps us to understand the 3 buckets that I was talking about: the investment level, allocation of assets, and income. And so we do ask that everybody fills out that intake form and submits that. And that pretty much will give us all the info that we need to have that one-on-one in-depth conversation and, make our best recommendation.
Great. Thank you so much.
Yeah.
All right. Well, thank you very much.
Thank you.
And without further ado, we will get you will get a little invitation to join the breakout, or a link to join the breakout session with your coach. Okay.